Thank you for the use of your offices. We really appreciate it. Great to see everybody. And I am so envious of everybody that is live and in Austin, Texas and enjoying Tech Week down there. It's a great, not only great from a business side, but there's a great cultural feel to the whole thing, with the restaurants and the entertainment that takes place during that week. So you should be having a great time down there in addition to learning a lot and doing a lot and hopefully making a lot of deals. I'm pleased to kick off the first panel discussion of the IvyFON Austin program and thank all of you who are there in person and those who are, I see we have a little rearrangement going on here, trying to center our folks. Figure out the chair situation. There we go. All right. We have a great crew here, a great number of people to talk about this. And Austin will know it has made it when Chip Perkins moves out of Florida and moves to Austin. Then we will know.
I already have a house there, but
there you go.
I've had 2 kids there and an ex-wife, so I'm staying in Florida.
All his exes live in Texas. Sorry, it's a bad joke about old country song.
So Scott, thank you very much for your introduction this morning. We also have Danye Wang here this morning. Danye is, I understand, also just returned from a trip recently. So Danye, welcome again this morning.
Thanks, Mark. I'm actually physically in Austin. Just
are you? Okay.
Had an obligation this morning, but plan to join in person in the afternoon.
Fantastic. Marty had mentioned that you're going to join them for dinner, so I'm glad to hear you're going to get over there and get to meet everybody prior to. And just for people's awareness, Danye is a managing partner of UniGlobe. She represents various Asian families with making investments in the U.S. market was absolutely critical during the time of COVID. And she's going to have a lot to talk about, selecting managers and then managing those relationships. We have Blake Singer, who is in Austin, Texas. Blake is a senior manager with CMG Capital Management Group, who provides wealth advisory services to ultra high net worths and also family offices on strategies to this ever-changing dynamic market that we're in. Chip is a capital raiser. He runs Perkins Fund Marketing, and he's the managing member there. And since about 2008 or 2007, he's raised $25 billion for fund managers. So looking forward.
I have not raised $25 billion. If I did, I wouldn't be on this call.
Well, correct me. What's your number?
Since 1997, we've raised just under $8 billion.
At $8 billion. My apologies.
If it was 25, really, I'd be very happy. Believe me.
Understood. My apologies to you. I need to take better notes on our call. This morning, we're going to talk about a bunch of things related to manager selection, including investor appetites, perspectives of domestic and international investors, relationships between investors and managers, ESG and fiduciary role, emerging managers, the role of and value of placement agents, due diligence, and so on. So we got a lot to get to. My name is Mark Heil. I'll be moderating this. I'm institutional sales for Pacific Premier Trust, a division of Pacific Premier Bank. We are one of the largest and most experienced non-fiduciary custodians that focuses on the custody of alternative assets, including self-directed IRAs and private fund custody. And a question I get from a lot of people is, Mark, how do you fit into this? Well, again, we custody alternative assets investments. Just to give you a couple of quick examples, right now I'm working on a deal where a private credit asset manager is looking to custody with us $3 billion of loans. So we're in that discussions with them. Also recently onboarded an RIA that had about 700 investors. So we're custodying their retirement investments for that manager. We do some taxable accounts for them as well. Working with a group that is putting together a large SPV to invest into a larger manager. The RIA is committed to putting in $50 million, and we're custodying for them about $10 million that came through retirement accounts. And last but not least, we're involved with an ESOP that is being modified, and the people that are leaving the ESOP need to roll their money into a retirement program, so we're going to custody those things. So that just gives you a flavor for how we interact and why we're in this. And if you heard Chip a bit earlier, he alluded to the ever infamous disclosure here that I have to give being a member of the bank. So Chip, just bear with me. I know you probably could
Only my
recite this.
37th time.
But Pacific Premier Trust performs the duties of an independent custodian of assets for self-directed individual and business retirement accounts, and does not provide investment advice, sell investments, or offer any tax or legal advice. Clients or potential clients are advised to perform their own due diligence in choosing any investment opportunity, as well as selecting any professional to assist them with that investment opportunity. Alternative assets are not FDIC insured and are subject to risk, including the loss of principal. Pacific Premier Trust is not affiliated with any financial professional, investment sponsor, or investment, tax, or legal advisor. We're a wholly owned subsidiary of Pacific Premier Bank. And I'll just add to that, if I espouse any opinions, they're mine and mine alone. The bank does not necessarily share in those. So with all that behind us, I want to get started on a discussion for the next hour or so. We're going to be talking with these fine people, but first let's just get to know them. So Danye, you want to maybe just introduce yourself and talk a little bit about what you do and give people an idea of how to interact with you?
Absolutely. Thanks again, Mark and Marty, for having me again. I'm New York City based. For most of my career before running my own advisory firm, I was in institutional sales with BlackRock, focusing on some of the larger relationships, sovereign wealth fund, central bank insurance companies, and did a lot of work cross-border, primarily with Asia, but also Europe and Middle East. About 4 years ago, I started UniGlobe Capital with the original intention to work with China managers and help them to construct cross-border deals and expand their LP outreach internationally. But in recent years, given some of the policy changes and the direction of capital flow, and as I build out the ecosystem of family offices, both in the US and especially in Asia, I started representing a few of the largest Asian families, specifically on their allocation in the US, mostly venture and growth equity. So for early stage ventures, given most of the families don't have the bandwidth, the infrastructure, or the capacity to conduct deal by deal due diligence, we would go through funds allocation. But when a certain deal comes to growth stage, it makes a lot of sense to put together SPVs. I've done a co-investment with other US families and obviously also take advantage of any co-investment programs offered through a venture or growth equity fund. So I have a lot of focus on venture and growth equity from an allocation perspective, although the family's appetite are quite diverse as well. Marty just mentioned about crypto mining. A few of my families are very big on that. And we all know that crypto mining got restricted in China more than half a year ago. So there was a lot of movement and appetite there. Crypto Web3 in general is a big trend, but also healthcare, life sciences, medical device, digital health, that's a big area of focus for my families as well. And from a sector perspective, consumer enterprise, that has always been interesting for Asian families, as well as especially when they look at US opportunities. So I would welcome any engagement with quality funds. I like emerging managers. I mean, back in the days from BlackRock's platform, I had access to a lot of like brand name funds, but I know from a family office allocation perspective, we really appreciate sector specialists for people who have either spin out of bigger platforms or had previous experiences and strong and deep industry insight, and we can be very specific about a sector and that type of skill set and the eagerness of an emerging manager, but mature investment style is something I'm absolutely interested in.
Now, that's fantastic. We're going to dive a lot into, your sector specialist this morning, and how you find them, how you choose them, what makes them, attractive to your families, and why they're interested in that strategy. So we'll pick up with that in just a few minutes. Scott, I know you gave a nice, warm, long introduction there at the beginning, but maybe you want to put a little color around, maybe share a few things in addition.
Sure. Well, first thing, I don't select any managers. My clients do that, but I might help unselect managers. So depending on the terms that appear in their fund documents, whether or not they actually reflect the deal, I do a lot of custom funds and separately managed accounts. They're one-off deals, and more often than not, at least when I get the deal to look at, where the terms are not in 100% compliance with my client's expectations. So fortunately, I can say probably I can count the number of deals that have died on one hand, but it's more than zero. So my involvement in manager selection really comes down to, do the terms reflect the deal from my client's perspective? And if not, how do we make that happen? How do we find creative solutions to deal with both parties' needs in a way that works for everybody? And that's usually what happens. But sometimes it takes a little bit of thought and a little bit of time.
Yeah, and alignment's a huge issue, and how you get that to match up through a PPM and terms and all that is huge today. So we're looking forward to your comments and insights there. Blake, why don't you take a couple minutes, tell us about CMG and your role as a senior advisor there.
Thank you. First of all, Marty, thank you for inviting me to the forum. And Mark, thank you. It's good to be in Austin. Country music, Western music, obviously, is very big here, and it reminds me of Bob Newhart, who is a very dry comedian, who said, "I don't particularly like country Western music, and for those of you who do like country Western music, I don't mean to disparage you in any way. And for those of you who do like country Western music, disparage means to put down." Anyway, with that, I work as a consultant and an advisor to CMG Capital Management. My background has been more on the buy side. I started at Smith Barney in the portfolio management department on the West Coast. Started a traditional investment advisory firm. In '99, we started a special purpose vehicle to invest in emerging Latin American private equity. At the time, we had GE Capital and Soros Fund Management. The late John Templeton as who seeded that. We ran in the early 2000s about a $400 million more institutionally focused hedge fund. It was StatArb. We had clients Aetna Life Insurance, Deutsche Bank, European family offices, et cetera, and private banks. And that ARB went away, as they typically do. We had a good run and sent all the money back. And since then, I had created a trade finance company with offices in Brazil and Pretoria, South Africa. And before I moved from Portland, Oregon, where I'm from, to the New York area, or the New York metropolitan area, I'm just outside the city. I was consulting with a family office, managing we basically converted their substantial municipal bond holdings to a large real estate portfolio, both direct and through partnerships. And as their operating company grew, we used tax loss carry forwards that they had to basically reduce their equity portfolio. And I kind of consulted myself out of a job. So I work with a partner, Luis Medina. We've worked together for over a decade, and we have one client, which is CMG, and we've built out their wealth management alternative platform. And I'll get into more of that later. So thank you.
Fantastic. Thank you, Blake. And by the way, my favorite line from a movie dealing with country Western music was, of course, the Blues Brothers when they're in that hick bar. And Jake Elwood says, "We play both kinds of music, country and Western."
Well, hope it didn't offend anybody. I do like country western music, but
So do I, but it's a
like
funny
Bob Dylan.
line. Chip, let's go over to you and the 8 billion that you raised, not the 25 billion. Let's talk about a little bit about what you do, who you represent, and give us a little background on Perkins fund marketing.
Okay, thanks, Mark and Marty. Thank you for having me back again. Danye, nice to see you. Scott and Blake, nice working with you today. Our firm, I started our firm May 1st, 1997, so we'll be 25 years old in a few months. We are a registered broker dealer and also overseen by, it seems like, every government agency that's known to man in the securities business. We have been primarily working in hedge funds over that 25 years with all sorts of different strategies. Probably the only strategy we haven't done to date is crypto, and that's just because I can't figure it out yet. And I'm trying to understand and find a great manager to represent. But I have 7 people on my team. We do tons of due diligence. We see lots and lots of managers every year, but we only select about 5 to work with. So we keep that under control so that we can, when we finally get somebody on the phone, we're able to spend quality time with them and determine whether or not our managers are fit into their portfolio. Everybody in my firm is registered. And as you know, to present firms to qualified investors or investors at all, you need to be registered to stay within the law. We work with family offices, fund of funds, endowments, foundations, pension plans. All depends on the size of the manager we're working with and what people's interests are. But we work with emerging managers, we work with established managers. One thing I'll tell you on the emerging managers, it depends on who you're talking to. What is an emerging manager? I get family offices that talk to startups, and I have pension plans that say a 10-year track record and $10 billion. Anything around there is an emerging manager. So it just depends on who your audience is. And I'm very glad to be here and share insights from what we do once again. So thank you.
Yeah, I'm looking forward to hearing your insights here, Chip. Particularly, you know, I understand you just returned from a trip from the Middle East, capital raising trip, hopefully successful from your point of view. But I'd be interested in just, you know, getting a little color, especially with things that are going on in the world, about their insights and attitudes about investing into America right now, or investing in American managers. And
Well,
maybe you aren't representing an American manager over there. I don't know. Maybe you're representing an Asian manager. But
well, it was a combination trip of representation of all the managers in our book, but also learning more about what they're doing and you know what their interests are. It's fascinating. I've only been there twice. Last time was 15 years ago, and the change is extraordinary. I sat with a guy who's been there for the last 50 years, a guy from Manhattan, from Little Italy, who was invited to come after learning and meeting some guys from the Emirates at NYU. And he and his family have spent the last 50 years there helping build out the Sheikh's dream and creating opportunities. But what I'll tell you they primarily are interested in is, you know, just like anybody else, quality managers, people that make money, do what they say they're going to do, and you know, stay within the lines of what they present as their investment opportunities. They love real estate. They have obviously a ton of new buildings and hotels and everything else in the Emirates, but they like, it appears, real assets and great investment opportunities, not dislike anybody else. But I will tell you that The country is safe. It is clean. It is fascinating to see how it integrates. But if you have not been, you should go and just experience it. My wife and I were over there, and it was just a great experience. Great experience.
Terrific. Scott, sort of along the same lines, you represent large LPs, endowment funds, sovereign funds. With everything that's going on right now in the country and the world, how are your investors feeling about the market? Are they saying, they need to take more risk right now in order to achieve higher returns to compensate for inflation? Or are they saying, hey, we need to become more conservative? What is the general feel from your clients right now?
Well, that's it's an interesting question, and it comes in sort of two time frames. If you were to ask me that question 2 weeks ago, right, I would say there was still a push for more risk. At the same time, though, we've had some clients, some like public pension plans, reduce their target rate of return because they just weren't getting it right. Definitely seen a shift over the last several years to more private assets, a lot in credit. It seemed like for a while every other fund I was getting to review was a credit fund. It probably lasted about 2 to 3 years actually, and then the last year-ish, digital assets, just digital assets, which is actually going to be one of my questions to everybody to kind of ponder about manager selection. And I'm scratching my head because I also have trouble getting my mind around crypto and fiat currencies that I fear governments are going to shut down one day and everyone's going to be left with worthless assets. But that's just my naive view. But it seems like a lot of my clients are at least dabbling in digital assets of some sort, and it's been increasing over the last probably about a year that I've seen. As far as like with the war in Ukraine, I haven't really talked to my clients about that in particular. I don't think because no one's talked to me about it, it means that they're probably not making massive shifts about it, and they're just taking more of a wait and see approach, believing I would assume that this is not going to be a protracted conflict. My own personal view about it is, what happens when the conflict is over, right? Let's just say hypothetically Russia wins and sets up puppet governments, or even worse, case scenario, annexes large parts or all of the Ukraine. What happens with the sanctions? Do they last forever, right? Do we have a whole new world order based on that? Or do we go back to normal and normalize relations with a now larger Russian state? Those questions I'm personally very nervous about, and I would assume that my clients are very nervous about as well. I'm sure there's a lot of companies right now who are temporarily no longer doing business in Russia that are very concerned about, is this a 2-month thing, or is this a forever thing, or foreseeable future thing? And those are going to have, I think, major impacts. But if you look at the market itself, just the public equities and things, they took a pretty big dip, but seem to have stabilized and rebounded to some degree. So, the general consensus out there seems to be that this is not going to be a long-term market disruption, but who knows, right? We're dealing with interesting times, the old curse. So we'll see.
It seems like we're always dealing with interesting times, but they just seem to have gotten heightened. Danye, I want to throw this your way, and again, it's are your investors more conservative now? Are they saying, hey, let's be careful, let's really work with the investments we have? Or are they saying, let's find more? Are they looking to raise the bar? Are they looking to achieve higher returns? through taking on more risk?
Yeah, it's a complex and case by case question from my perspective. I guess there were a lot of wealth creation from Asia in the last decade or so, but the money to be made going forward is going to be different from how money was made 10 years ago. You can pretty much blindly just invest in real estate and gaining 30% almost guaranteed return in China, but going forward, that's not going to happen. So from one end of the spectrum, I think all these family offices historically weren't able to hire institutional trained, sophisticated CIOs and investment partners, but now they're getting to a stage that they know this is an industry where professional players have an advantage. So from a talent building, talent pipeline perspective, especially the larger family offices have all built up their capabilities with sophisticated institutional trained investors. So that's one thing, which means they will focus on asset allocation. They will focus on diversification. They'll think about short-term liquidity, but also long-term gains, and they'll think about global allocation as opposed to just investing in Asia with a regional focus. But the other end of the spectrum is that a couple of folks also talking about the growth of digital assets, and historically Asian investors are very aggressive when it comes to return profiles they're looking for. So a lot of people will be looking at crypto asset as the next big thing, and it will deserve a slice of allocation from their portfolio. One of my clients who is a tech founder, and his company got acquired by Alibaba 3 years ago for 9.6 billion. And this guy and his family office is allocating 5% of their entire portfolio into crypto Web3 related asset, and that's equivalent of 250 million. And obviously they have already allocated to a lot of the larger players if they can get an allocation, but right now they're seeking more emerging managers or people who kind of have a unique approach. So from their perspective, they do understand that this segment of the asset could potentially go to zero even, but it also has significant upside, and they don't want to miss out on the market. But obviously they are mapping out the market. It's interesting. I've seen the journey they have taken. First of all, allocating to some more established brand name players if they can get the allocation. Then they're doing a geographic mapping of Asia, the US, and kind of the rest of the world, and screening managers in a more systematic way. So I do respect them on that. But I do want to say the other reason why a lot of the Asian investors got pretty excited about crypto is also, I guess, just the duration of the investment life cycle, because we are looking at a venture, even growth equity. A lot of these funds are at least 5 years, sometimes up to 10, with another 2 years of extension. And Asian investors a lot of times are less used to a true long-term mentality, but in the crypto world, there's more liquidity, and tokenized way of investing can provide liquidity, even if you're investing venture-like opportunities. So from that perspective, it is attractive to them. But I've also seen a lot of Asian investors continue to allocate to real estate, learning more about private credit type of investment, where probably the time duration is about 3 to 5 years, but also generate a reasonable enough returns. One good news for, I guess, US managers out there is that given the return profile of Asian investment opportunities in region has came down a lot in the recent couple of years, and some of the political uncertainties or policy changes in Asia, especially China, a lot of these investors are looking more seriously outside of Asia for more stable and rational investment opportunities, and the return profile has become more realistic. But that's, I guess, my perspective.
Yeah, that's a lot of interesting that you spelled out there. And one of the things that struck me, and Marty, maybe you want to chime in here just a little bit, and because I find the whole digital thing to be fascinating, the digital currencies. And I remember back in Miami, Marty, and correct me if my numbers aren't right, like 40% of the people at the family offices at the event in Miami said that they held digital assets. And then a couple of weeks later, we were in New York, and very few people in the room, very few of the family offices there said they held the digital assets. So you want to comment just a little bit?
I'm just going to just jump in here for 2 seconds. And it's about 40% in Florida, but I think it's a much higher. It's pretty high in New York. We're a pretty savvy group. We've been into the crypto space for a while. So
okay, so fair enough.
My only comment to Danye is that because of gaming, online gaming and things like that, I mean, if you know, it's a $250 billion industry now, which is much bigger than Hollywood, right, for entertainment. If you look at crypto on online gaming, you can't do Web 3.0 without crypto. It's impossible. So anyway, and Web 3.0 will be huge.
Absolutely. It's a long-term play. There's money to be made on short-term, but the whole industry is a long-term play.
Got it. Blake, I want to get you in here very quickly and have you talk about, you represent a lot of ultra net worth, high net worth individuals, as well as family offices. What is their attitude towards the current market as far as you can tell?
Well, it kind of depends on the family. You know, if it's depends on when the wealth was acquired or accumulated. We have been taking more of a risk-off approach for some time, and the reason for that is that, you know, markets are expensive. You know, it doesn't mean they're going to go down, but there's a lot of optimism priced into the markets, both on the fixed income side, particularly your typical off-the-run fixed income, and the equity markets. So we've been trying to identify strategies and managers that can provide returns that are almost equity-like or close to it or even above it without the same type of volatility. And that's been a challenge. It's been kind of fun to identify some managers. So I would say that just in this last run up in interest rates, people are beginning to see in more balanced portfolios, if you will, that don't have a lot of exposure to alternatives. Wow, you know, they're starting to lose money on their fixed income, and with the volatility in the equity markets, that's compounded it. We try to advise clients to kind of look at a longer term perspective, not recognizing where we've come from, really since the early 80s, when rates, 10-year treasuries were at 15.5%. We've been in a really virtuous cycle, 40 years of virtuous cycle, and most managers have only operated in that period of time, myself included. But, you know, with the 10-year treasury at maybe it's around 2%, 1.9%, the kick from falling interest rates, which pushes up all asset prices, you know, in the next couple of decades, it remains to be seen. It's going to be tough. So we're looking for really businesses, strategies that operate as businesses that generate cash flow, that generate return, that aren't as contingent upon somebody coming by and paying a higher price. When it comes to crypto, which was discussed, we've been looking at that. My partner is younger than I am, and so he's much more apt to look at that. But we've been talking to a number of one premier crypto shop that runs a lot of variety of strategies, and I got a kick when the 28, nothing against 28-year-olds, my son's 28, but was talking about they have a fundamental manager in crypto, and I got a kick as to what fundamental analysis is in crypto. But much like the gold rush, we would prefer to be in picks and shovels and the back end do it rather than trying to determine which particular currency or which NFT is going to be the hot one. We are very closely we're looking at a equity market neutral crypto fund, which is fascinating because typically in early markets, be it early mortgage markets back in the early 90s or early in the high yield markets, the spreads are really high and there's a lot of inefficiency. And we find that a equity market neutral crypto manager is fascinating. They put up really good returns, and they're doing stuff I couldn't. It's an entirely different language. So we approach it a little bit differently, and I guess with a general more risk measured approach than just going out and going long crypto because it's going up.
So let me ask you, because you are speaking about people having equities and the equity, the turbulence we've seen a little bit in the equity markets. You've talked about the low interest rates. Obviously, we're expecting interest rates to rise. How many times we don't know this year? How much we don't know? We'll start getting those answers soon, I understand. But it seems to me that there's an expectation that equity markets could drop. So how are you advising your clients right now? And obviously, we're not giving advice here, but just generally speaking, about what to do with those gains that they've had over the last 10 years in the equity markets. Are you advising them to put that money into alternatives and try to lock in some of those gains? How are you helping them think through those issues?
That's a good question. I grew up in the business, and in forecasting, my father always said, if you're going to predict often. So we try not to predict, even though the market's expensive, where it's going to go. But with clients that have had and benefited either through the monetization of their own technology companies and low basis stock, or long legacy positions, in the last year and change, we've taken advantage of some opportunity zone investments to convert some of those embedded gains into ultimately income producing real estate. We've identified two. One was seeded by one of the most foremost family offices, very well-known family, and the patriarch in the family was living. He created a trust that lasted 3 generations, and the last remaining member of the 3rd generation passed in 2018, and they went out to seek a opportunity zone manager, and we were able to invest alongside that family. It's now closed. They may be opening another one, but that allows clients to convert really low basis or no basis equities into a longer term return stream that will generate cash flow at some point, but defer their taxes for a long period of time, and if not, eliminate them depending upon how it's structured. So that is kind of a unique opportunity that came with the Tax Cut Act in 2017. So that's an example of some of the stuff that we're doing. It just depends on the basis and the length of time in which the family is looking at. If it's multi-generational, a lot of factors are going to play.
Yeah, these have got to be the conversations taking place, not only certainly at family offices, but also at the institutional investor level and places where maybe it's not as easy to change and shift things. But Scott, I wanted to turn back to you a little bit. And again, we're here about manager selection. So from a manager selection viewpoint, what are the most important considerations from an institutional investor about how to pick and choose?
I cannot believe you just asked me that question. Only because, as a lawyer, it's just really not my thing. The consultants that my clients work with are really, really good at that sort of thing. And I'm sure there's a lot of people in this room that are really good at that sort of thing. But I just don't get involved at that level until someone's basically selected, but for legal terms. So I'm giving you a little bit of a hard time here, but
that's all right. Well, I want to know what their concerns are, is what I'm trying to get at. What are their concerns? What are they examining? Because you're the one that sort of has to flesh it out for them, right?
Yeah. Well, certainly, there's back office operational due diligence that's going to go on. Consultants will do that, or some of the larger investors have their own people who will do that. Certainly looking at the asset class, how does it fit into the overall portfolio of the investor, right? There's somebody, whether it's the CIO of the investor itself or an outside consultant, is doing asset allocation and making those determinations, and maybe forecasting frequently, right, and changing those up sometimes more frequently than others. But once that's determined, typically most of my clients, who tend to be larger institutions, will have specialists in the various fields. And you may have, somebody running the real estate program, somebody running the private equity program, somebody with hedge funds or long only, et cetera. And they're going out, looking at track record, looking at strategy in particular. How does this fit? They don't want a ton of overlap usually, right? They want to have a diversified portfolio. And then a number of my clients do have emerging manager programs, right? So I know there's a focus with this particular meeting on emerging managers, and some of our clients have formal programs on that. And as mentioned earlier, what that means varies from investor to investor. Here in Texas, it's actually statutory, at least for the public plans, what emerging manager means, and it's asset-based, right? It's a simple asset-based test. The manager could have been around for a long time, or a very short time. It's purely asset-based. In some places, in some people's minds, it's women and minorities, for example. It's a different focus than just purely, is this somebody who we think, based on a proxy test, is just getting into the business. And of course, you could come in with $100 million in assets and have been operating for a really long time and still qualify in Texas as an emerging manager, but maybe not in other jurisdictions.
Mark, I have a quick question for Scott. Hey, Scott,
Sure.
Can you talk about how things have changed in terms of terms that you look for in a contract, like over 10 years? I mean, I think the whole fund industry has changed dramatically, and also are there specific terms that you look for, that your clients are looking for? And I know that also there's been a whole new genesis of how limited partners look at investing. So can you give a very short
I could talk about that for about 6 days, but and we've got long checklists to handle that sort of thing. I think as investors become more sophisticated, they look at more things, quite honestly. And from an emerging manager standpoint, this is a real challenge for them, because you may have a manager who has been working with wealthy individuals exclusively, right? Friends and family to begin with, and they expand a little bit into wealthy individuals. And then they run into, maybe a smaller family office that's got a real small team, or one person who's maybe more of a term taker. And then they run into, as they get a little bit larger, a bigger family office that may have a real sophisticated team that might have worked at real sophisticated asset managers or allocators before, or they take their first public pension money or something like that, and it's a wake-up call, right? Suddenly the stock document that their lawyer prepared, that everyone else just signed on the dotted line, is being sliced and diced, coming to folks like me who put it through the ringer, and we're coming back with 20, 30, 40, 50 comments or change requests. A lot of it's economic, right? The main areas are going to be economics. Do they reflect the deal that we thought they reflected? 2, are they drafted correctly, or are there mistakes? Are they consistent throughout the document? And 3, are they, do they make sense, right? And are they tax efficient, depending on who your client is? Those are some real wake-up calls for younger managers who are really focused on running a business, or running, investing, not necessarily on fundraising. The other main area that we see is in risk allocation, liability between the parties. Like a lot of managers do not want to take on fiduciary risk. They want to have their own money invested in their fund, and they want to be able to act in their, to protect their own money, which their own personal investment concerns might not match those of other investors, right? They might be more or less risk averse, for example. Those are real challenges that people have to think through. And so on the one hand, everyone, I want manager alignment. I want them to put as much money as possible into this fund. There's actually kind of a sweet spot, and it can vary by strategy and vary by manager, but I've definitely run into situations where the managers have like 40% of the money in a fund. Once you have a manager that has that much money in the fund, and especially if it's the bulk of that person's or the 90% of their net worth is in their own one fund, there's actually an alignment problem that people need to think about. And now it's suddenly, this is my personal money, and I've been so kind to let you tag along. And I might get really risk averse in this in this market disruption or whatever, because this, if I lose this, everything in this fund or a significant amount of this fund, my life is going to change significantly. Whereas the other investors are like, no, we understand that risk, and that's fine. We don't want to get too conservative. So that's something to think about in the whole fiduciary standards there as well. I'll tell you right now, like the big term that my clients seem to be most interested in, because it's relatively new, is rollover funds. This would be more private equity based. But a number of the funds coming out that I'm seeing now are building in rollover fund terms, which basically means, for those who may not have seen this or use a different lexicon, it's pre-wired plumbing within the document to sell one or more assets of this closed-end private equity fund to a future closed-end private equity fund or special purpose vehicle, because the manager has determined either that it's not the right time to sell that asset, or perhaps there's no buyer. They've tried to sell it and there's no buyer. And there was a huge push against what we call zombie funds for a while, where these private equity funds had one asset on the books. They couldn't get rid of it, and they would just extend their term, keep getting management fees every year. And a lot of investors were up in arms about that. I don't know for sure if that's the reason why these rollover funds were created or not, but it makes sense to me. And so now we've got this other problem of private hard to value assets that are being sold from one fund to another fund that is going to be made up of a lot of the same investors, but not exclusively. And what do you do as an investor? If you're given a choice, which you should at least be given a choice, in my opinion, do you participate or not? And it becomes a cash out situation for the GP, and valuation becomes a really huge issue. So that's kind of the biggest thing that I'm trying to tackle with my clients right now, especially in private equity funds, is dealing with this, because it's not all bad. There's some upsides to it, and you get a very fractured LP base on this question, as opposed to certain questions which it just lines up very easily with, it's good for the manager, bad for LPs, or vice versa. It's a very easy way to get people on board with one LP's position. But in this particular area, it's like client by client, manager by manager, as far as what's the right answer. But I am seeing more and more aggressive plumbing, or even when the plumbing doesn't exist in an existing fund, what I would call some false choices being presented by managers of, hey, we're going to do this, and you can participate under these terms, or you can cash out at these terms, and those are your options. And when actually there's a third option, which is we just say no to the proposal altogether, and leave everything in the existing fund. But that option is often not enumerated in the choices. So that's where really knowing your rights and going back to the original documents matters. But that's also where, with the funds that are now pre-plumbing for this, these rollover funds, you got to be really careful on what you agree to up front, because 10 years later, when there's two assets on the books that are out there, you may be effectively forced into a choice that you don't want to have. So you got to be forward thinking about what you're going to be comfortable with in that situation, as opposed to the old status quo, which is to leave it in the fund and hopefully renegotiate management fees down or something like that if an asset just is staying on the books longer than anyone anticipated.
Yeah, I think there's a lot of risk there, particularly from the SEC point of view, a lot of conflict potential, a lot of issues that they'll take a hard look at. So your regulatory side of your practice will certainly love those questions as you present them to them. But I would be very careful and certainly make sure I document everything in that decision-making process. If you decide to roll it over. And I think alignment of interest is a huge topic, and I really want to discuss that some more, particularly around waterfalls and things like that. But I just want to shift over to Blake for a minute. And again, you don't have the leverage that the large pension funds do, most of your clients when you're in a fund. So how do you compensate for that when you make a decision to invest?
In terms of leverage, in terms of terms or access?
In terms, so yeah. I mean, if you're investing in, and maybe your strategy is not to be in a fund where there's a large LP investor. I mean, lots of ways to deal with these things. But the question is, how do you try to mitigate the risk of being dominated by another large player when you go into an investment?
Well, that's a really good question. You don't need us to get into, there are all of the big name brand private equity, big hedge funds, that many of which we have access to. But in terms of, I guess, we basically look for managers that are, I wouldn't call them emerging, but they're oftentimes capacity constrained strategies. So I'll give you an example. There was a group that all tenured investors, 25-year plus credit, both private credit and all credit, essentially on the run credit, that came out of Wall Street, and they began working with one of the largest, most prestigious college endowments. And they left, they spun out that endowment, seeded them with about 300 million and added some more. And they run some trade finance strategies. They maybe run $3 billion and financing supply chain. And while at this large endowment, they were asked in 2013 to supply credit insurance, or basically credit default insurance, for vendors selling to large corporations, retailers. So think of a jeans manufacturer in San Diego selling to Macy's, and maybe they have a third of their business to Macy's. They want to have insurance that if Macy's goes bankrupt, they will get paid off on their receivables. So this firm has created an entirely new market niche in writing this insurance. It's not insurance that goes through an insurance regulator, but it's basically credit default insurance on the purchase orders that are outstanding. It's very short term, and that coupled with their trade finance business, they've created a $100 million fund, of which we were very early on and seeded, and they've did a soft close. We don't have, their normal institutional minimum, I think, is about $100 million or $50 million. So we don't bump into being kind of moved around. We work very closely with them, and that strategy, has historically returned, high double-digit returns. It's really very unique. And so when it comes to setting terms, we're not in a position to set terms. We, look from an operational perspective, if there are elements of, if a particular manager has 35 or 50% of their money coming from one source, and the terms that manager or that investor has have maybe enhanced liquidity terms that could affect the entire fund, yeah, we look at that. That's a big issue. And that's just an operational checkpoint. We don't see that very often because most investors don't want to be that large of a position in a particular fund, and it creates the issues that I just described. So, you know, we don't bump into it. We're not of the size where we can come in and dictate terms and fees. However, we do invest alongside some firms in the private equity area that have been doing it for 40 years. They run a fund of private equity funds, and about 50% of their portfolio that we invest in is without fees, because they'll often be the seed investor for a particular private equity's, call it their 7th fund, and this firm may have been invested in their funds 2 through 6. And when they launch a $1.5 billion fund, they'll come in with $250 million, with the caveat that they can invest another $250 million on the side as a co-investment. So they can extract terms that even if we had a couple of $1 billion, we couldn't extract. So we'll look for situations like that when we can. And certainly co-investing is an area that is really interesting in the private equity side.
Oh yeah. Oh yeah. The co-investing is something we're definitely going to drill down here, and, you know, particularly hoping to get the insights from Chip's point of view on that, as well as Scott's. Chip, but first off, why don't you sort of tackle the same question? I just want to let everybody know Danye is having some technical difficulty, so she's switching over to her phone to connect here. So we'll be picking up with Danye in a few minutes when she gets back in. But Chip, why don't you step in and talk a little bit about, you know, again, you know, how you deal with how your managers deal with the conflicts that may occur, or how they try to handle that up front to align everybody's interest in their funds, particularly when you're dealing with a lot of different types of investors.
Yeah, what we try and recommend to our managers is, you know, you don't want to have somebody who's too big in your fund, because there's business risk. You know, if you have capacity of $1 billion and you have somebody who's taken down 250 million, and then you've got a whole bunch of guys that are at $5 million. If that $250 million guy decides to leave for whatever reason, you're going to have a run on the bank. You're going to be like, I don't know, he must know more than we do. So that's always a concern when you're building out a portfolio of investors. You know, not to have too much concentration in one guy. Most of my investors don't mind it when the manager has a high concentration, or a majority of their liquid net worth in the fund. I do think that it is concerning if you have, you know, a $500 million fund and the guy has been terribly successful in life and he's got 250 million. He may start to invest not for growth, but for tax purposes, and may miss some opportunities to take a little more risk if they're very concerned about their own personal investment in the fund. But mostly, I think that everybody is focused on being aligned, and that is very important. You know, the other side of that might be if, you know, somebody's been terribly successful and they have a whole bunch of real estate, and, you know, and very little of their assets in the fund next to their investors. People worry, you know, where's your focus? Where's your focus? So the managers need to be aligned with their investors at all times, and be striving for returns in the way that they explain to their investor that they would be.
And talk to me a little about co-investment, if you would. You know, you have managers or talking to LPs and they're saying they want to have co-investment rights. What are you advising them? What are you saying to those managers about that situation, about that request?
Well, the managers, if they, again, I work primarily with hedge funds. I don't work with private equity very much. And on the private side, I think it's different. If you're an LP in the fund, and there's more opportunity for the manager to invest in a particular investment, I don't think they should. I think they've got to be careful on how they charge those investors. And I think they have to charge them differently than if somebody comes in who's not an investor and wants to get a piece of the action. Those people should be charged full fees where their investors should not. I do have managers that have create special purpose vehicles for investments that are outside of the fund or similar to something that's in the fund, but again, they don't necessarily have enough money in their fund or a willingness to get too concentrated in a position, that then offer the SVP opportunity to their investors and sometimes to outside people. But the same rules apply, I think, is that they need to be careful in what they charge their current investors. But people are definitely looking for special purpose vehicles, side pockets, whatever you want to call them. But they should review those individually. It's not the same as the discretionary opportunity to be just invested in a fund. But there's a ton of interest in it, just like there's a ton of interest in families currently that want to make direct investments. So, the environment's changed a little bit that way.
Sure. Scott, what are you hearing in the co-investment area? I mean, particularly when you sit down, your clients say they want it. What are your concerns about your clients, and then also about the manager that's offering those?
Yeah, no, the co-investments are very hot. They've been hot for a while. A lot of my clients want them. Managers want you to act quickly. I mean, if you're not putting money in a dedicated co-invest fund, that's kind of hardwired, which is more the exception. But you're doing one-off co-invest. Managers want speed more than anything. Whether or not there's fees and carry involved is sort of case by case. But there's really there's two basic forms of co-investments that you have to be cognizant of. One would be a co-investment that's basically placed in an SPV or some sort of co-investment dedicated fund, where the investor is actually investing in a pooled vehicle, if you will, that the manager is controlling. That's kind of one rubric. The other is everybody's investing directly in the underlying portfolio company. And those, while the business analysis of a co-investment versus a fund investment is very different and very different skill sets, similarly, those two different structures require very different analysis as well. In the former structure, you can rely on built-in alignment with the manager, because you're all coming in. You got the main fund investing in the company, and then you got this SPV investing in the company. The manager is setting the terms. They're presumably setting everything to be pari passu, and everyone's sort of is dragged along of this investor group to exercise the same rights at the same time, because it's all done with a single investor or two manager-controlled investors. But in the other case, where everyone's going in directly, you've got to look at this in a lot of ways like a direct venture investment. You have to worry about your own drag along and tag along and registration rights and all these sorts of things. It's you're investing in a private company. What are your personal voting rights on the board, right? What class of securities are you getting? What preferences are you getting? You can't just rely on the manager anymore. And I've seen situations like this where the manager, whether it's their own balance sheet that's on the books or whether it's just the fund that they're controlling, is actually getting different rights, is in a different class, or has like a shorter lockup or something like that than the co-investors are, right? And that begs the question, why? Like, now we have a lack of alignment or potential issue that could be created in the future. Why is that absolutely necessary, right? So it's a different level of analysis that has to be done. And for example, like when we get direct co-investments in, I send that to M&A and venture capital investing specialist, and I'll stay involved. But that's a different skill set than fund investment itself, and warrants a different level of analysis.
So Marty,
one other thing I would say, this sort of answers a question I think you had before, as far as like rights, co-invest rights. A lot of my clients seek them. Very few managers are willing to give them, and I think for good reason. If you give a pro rata co-investment right to everybody, it's kind of worthless. And it becomes a problem because some investors can't act quickly enough. It's one thing to say I want co-investment. It's another thing.
No.
It's another thing to be able to do them.
Yeah,
right?
nobody can find this fucking slot. I just kept.
Danye.
Danye, mute.
Nobody can find the spot. I don't understand.
Danye.
Hey, Marty, can you mute her?
Yes, she's muted.
Okay, thanks.
Hot mic.
Yeah.
A very frustrating morning for her, I can see.
So while I will certainly do my client's bidding and try to negotiate a co-investment right, usually it takes the form of an expression of interest, which is worthless from a legal standpoint. And what I tend to advise my clients is create the relationship. Having it in a side letter that you've expressed an interest is worthless. Nobody's going to look at that, 2 days after it gets signed. But create the relationship, and make it an ongoing relationship. Talk to your managers frequently. What are you guys seeing? Do you need any co-investment money right now? We're interested in co-investments. We can do them. And then do one. And then when you do one and you act quickly and you don't, give them too hard of a time on their terms, so hopefully they're good. But even if they are messed up and you can get through them quickly, create the model for the next time, you can do it. And then they're going to give you more and more and more and more. So it's really relationship based. And to me, that's the absolute best strategy. All this legal stuff, even as a lawyer, the legal stuff on co-investments and co-investment rights is almost worthless unless you can get some sort of really hardwired right, which is very rare. And you're still much better off having that relationship.
Fantastic. It's all about the relationship. Even when you come down to conflicts, there are other conflicts that happen along the way between different investors. Certainly, when it comes time to exit, not everybody's always on the same page. Some have the fear of missing out on more returns. Others want to stay. Others want to get out now and take off the table what's there. And there's a lot more options today than previously. But Marty has been for the last 10 minutes sending me messages saying you're down to a minute, you're down to 30 seconds. So I think it's time to wrap this up. So Chip's asking, are we having questions and answers? Well, this was an open discussion the whole time.
If you can answer your Q&A in 30 seconds or less, that'd be great.
But why don't we have everybody just give a concluding thought to this? What should the audience take away from this morning? And what is it that they should really understand about manager selection today? And Blake, I'm going to start off with you. And again, I think Marty wants us to be quick. So if you get 30 seconds or so, give us your thoughts here.
Yeah, I'll just follow up on the last topic, which is relationships. We look at managers, we look at having relationships, we look at investing in businesses rather than is it private equity, private credit, blah, blah, blah. And so I would encourage people to look as if they're investing in a business. They may not be investing in the LP itself, but what is the business that this particular strategy and fund is in, and what kind of moat do they have around it? And that's critically important. So it does come down to relationships, both in terms of identifying, getting access, and you want to be a good customer, a good client to the fund, right? It's a relationship, and the better the client you are to the fund, the better the relationship is, and I think the better the results. It's been my experience, the better the results you get. So
fantastic. Chip, I'm going to throw it your way next.
Okay. Listen, on the relationship topic, alternative investments are very different than anything else that you're going to invest in. You know, if you're going to invest in a mutual fund, you don't know who at Oppenheimer or Fidelity or whoever is going to be running your money. In this particular case, you're writing usually a larger check, and you should have the opportunity to get to know the manager, understand how they run their business, not just how they run the money, and ensure that you're comfortable with that. And you have to look at this not as a trade, but as a partnership, because that's what it is. You know, they're going to be an LP, and the manager has the rights to run the money, but you don't have to always agree with them. So get to know the manager, get to know their business, get to know how they hire, who they hire, and look at the whole picture, not just, hey, I need a credit manager, or I need a whatever because my consultant said so. Make sure it's somebody you're comfortable with.
And I think the better the relationship, the more likely they are to play ball with you. Danye, I don't know if you're on or not, but if you could unmute and maybe just give your thought. 3, 2, there we go. Awesome.
Hi, I am on, but not on camera. So thoughts on manager selection criteria, right?
Well, what we're just doing here is we're wrapping up, giving our final thoughts on the program, and we've talked a lot about developing relationships between managers and the investors.
Yes, I guess the only thing I wanted to add is that I absolutely agree. Alignment is very important, especially as my clients and family offices focus a lot on emerging managers. GP commitment and alignment of interest is something I focus a lot on. And I really resonate with what Chip just mentioned about not just think in terms of how they approach investment, but also think about how they run the business, how they approach a specific sector, what's really differentiating them, and how they're also building relationships with LPs, because we all know this is meant for the long term. And thank you. And sorry for the mess up earlier. Yeah, thanks.
Don't worry about that. It's great to hear your insights and really appreciate it. And I think having somebody like yourself between foreign investors and domestic funds is really important to help make those relationships stronger, better. Scott, you're going to get the final word.
Thanks. I think I'm going to say in a different way, from a different perspective, the same thing that everyone else has said, and that's from the lawyer's perspective, which is your investment decision defensible, right? 5 years from now, when it goes bad and someone, puts you up on a panel like this and asks you, why did you make that crazy investment decision? Can you defend it, right? Well, we did the diligence. We believed in the investment thesis. We did our homework. And at the time, under those, the diligence we did, which was, worthy diligence, it was the right decision to make. Investments are not guaranteed, as opposed to, well, everybody was doing it. It seemed like good. I just needed to find some credit manager. All those are not defensible positions. So you have to have conviction for good reason on who you're selecting and why, and be able to articulate that under scrutiny later.
Another great conversation, Marty. I got to tell you, this was a terrific panel. I really enjoyed it. We covered a lot of ground here. Although, to be fair, I still have another 20 questions to go. We could have done this for another couple hours. So thank you so much. Thank you, everybody in Austin. Thank you, everybody online.